So if you've tried to buy a house anytime recently, you know the feeling, right? Prices are just through the roof, and that mortgage you thought you could afford last year, well, that feels like a distant memory now. How in the world did we get here? Today, we're going to break down this high-stakes showdown between the Federal Reserve and the housing market. What is really going on? Let's get into it. To really wrap our heads around what's happening now, we have to jump in the time machine and rewind to the start of the pandemic. Because the housing market didn't just get a little warm, it went into a full-on five-alarm fire. I mean, we are talking pure, unadulterated chaos. So what did that chaos actually look like on the ground? Well, you had prices just skyrocketing. At the same time, the number of homes for sale totally cratered. This combo created these insane bidding wars for pretty much every property. It really felt like everyone decided to move to the suburbs at the exact same moment, creating this massive wave of demand with almost nothing to buy. But here's the thing, this housing madness wasn't happening in a bubble. This was all playing out against a much bigger, much scarier backdrop. Record high inflation that was making absolutely everything from your gas to your groceries way more expensive. And that is when the Federal Reserve stepped onto the scene. Seeing prices spiraling out of control across the board, the Fed knew it had to jump in and do something. Anything to cool the economy down. And this wasn't just some abstract economic exercise for them. The Fed came out and publicly said, hey, we get it. We see the real hardship this is causing for families. So their mission became crystal clear. They had to get prices back under control. Okay, so how does the Fed actually fight inflation? Well, their number one weapon, their go-to move, is raising interest rates. The whole idea is to make it more expensive to borrow money. If it costs more to borrow, people and businesses will spend less, and in theory, that pumps the brakes on the whole economy. Which, of course, brings us to the most important question for a lot of us. How does some decision made in a boardroom in Washington, D.C. actually trickle down and make your mortgage more expensive? It's not quite as direct as you might think. It all starts with this thing called the federal funds rate. Now, this is the one and only interest rate the Fed has direct, hands-on control over. Think of it as the interest rate banks charge each other for super short-term overnight loans. It's the first domino, the very foundation that almost all other interest rates are built on. So, how does that one little rate end up influencing everything else? The key connection here is the 10-year government bond. Investors see this thing as basically the safest investment on planet Earth. Because of that, its interest rate becomes the benchmark, the anchor really, for the entire financial market, and that includes mortgages. And right here, you can see the chain reaction in action. Step 1, the Fed hikes its rate. Step 2, that pushes up the interest rate on that super safe 10-year bond. And step 3, since mortgage rates are closely tied to that bond, your mortgage rate goes up too. It's a deliberate cause and effect, all designed to put the brakes on the housing market. But hold on, raising interest rates is only part of the story. The Fed has another incredibly powerful tool it can use, and it has to do with something called mortgage-backed securities, or MBS for short. So, what on earth are these things? Well, put simply, banks take a whole bunch of individual home loans, yours, mine, our neighbors. They bundle them all together into one big financial package, and then they sell that package off to big-time investors. And here is where it gets absolutely wild. To keep the economy from collapsing during the pandemic, the Fed became the biggest investor of all. It started buying up insane amounts of these mortgage bonds. We're talking about a staggering $2.7 trillion worth at its peak. That's trillion with a T. Now, the Fed's actions here have a real 1-2 punch. First, there's the direct impact. When the Fed is buying up all these bonds, it reduces the supply that's out there, which helps keep interest rates low. But then there's this huge psychological impact. The market starts to anticipate what the Fed is going to do. So just the announcement that the Fed is going to start buying can be enough to send rates tumbling. But now, that whole process has slammed into reverse. Instead of buying, the Fed is now, in its own words, significantly reducing its balance sheet. In plain English, that means they're letting these bonds go, which basically pulls a key support right out from under the mortgage market. So you can see the Fed is pulling out all the stops to cool things down. But you have to understand, this is an incredibly high-stakes gamble. The biggest fear is that in its all-out war against inflation, the Fed could accidentally tip the entire economy into a full-blown recession. And just to give you some perspective on how serious this is,
You have to go all the way back to 1981 to find the last time the Fed had to fight inflation this aggressively. We are in truly historic territory here.
And if you really want to understand the Fed's mindset right now, this quote from the Fed chair, Jerome Powell, says it all. He's basically saying, look, a recession would be really painful, but letting inflation run wild and become permanent, that would be an absolute catastrophe. For them, it's about choosing the lesser of two evils. So why is the Fed so incredibly determined, even with the risk of a recession? It's because they believe that price stability, predictable prices, is the absolute bedrock of a healthy economy. Without it, businesses can't plan for the future, families can't save, and the whole system just starts to seize up. Getting that stability back is their number one job, no matter the cost. And that brings us to the final and maybe the most important question of all. With the Fed on this relentless, aggressive path, is a major correction or even a crash in the housing market now inevitable? That is the billion-dollar question that everyone, from Wall Street to your street, is asking right now.